Welcome back to the channel, everyone. In today's video, we're diving deep into one of the most important moments right now for Applied Digital Corporation as the company heads into what could easily be one of the most consequential earnings reports in its recent history, with the data center operator set to release its fiscal third quarter results after the market closes on April 8, 2026. And right now, the stock is already reacting ahead of that event, with shares climbing around 3.6% to roughly $25.45 as traders begin positioning themselves. But what really stands out is the options market, which is signaling a potential move of as much as 16.5% in either direction, meaning volatility is almost guaranteed once those numbers hit. And this is exactly the kind of setup where big opportunities can be created, but also where risk increases significantly. So as always, just a quick reminder before we continue. This video is for educational and informational purposes only. It is not financial advice. Always do your own research before making any investment decisions. Past performance does not guarantee future results, and we are not responsible for any financial decisions you make based on this content. Now, with that said, let's break this down because the core question going into this earnings report is actually very simple, but extremely important. And that is whether lease revenue coming from Applied Digital's North Dakota data center campuses is growing fast enough to justify the company's rapidly expanding debt load. Because at the end of the day, everything comes down to cash flow and execution. And this is exactly why analysts like Darren Aftahi from Roth MKM have labeled the stock as a top pick going into this report, highlighting that this quarter will be the first one that fully reflects lease revenue from its facilities, making it a true test of whether the aggressive expansion strategy is actually starting to generate the kind of returns investors have been expecting. And right after the earnings release, management will be hosting a conference call where investors will be paying very close attention to three key areas, including the pace of leasing activity, progress on reducing the company's growing debt burden, and any updated guidance related to profitability, because these are the factors that will ultimately determine how the market reacts. Now, when we look at the bigger picture, the entire story around Applied Digital is really centered on its large-scale data center developments in North Dakota, particularly two major projects that could define the company's future, starting with Polaris Forge 1, where CoreWeave holds contracts covering 400 megawatts of capacity, and then Polaris Forge 2, which includes an additional 200 megawatt commitment that was revealed earlier this year, with Oracle later identified as the tenant. And when you combine both of these facilities, the total potential lease revenue comes out to around $16 billion over the life of the contracts, which is a massive number, and one of the main reasons why many analysts are willing to look beyond short-term losses and focus instead on the long-term growth trajectory. Because if this execution plays out correctly, the upside could be significant. And we are already starting to see early signs that things are moving in the right direction, as the company's most recent quarter showed revenue jumping an incredible 250% to $126.6 million, while the net loss narrowed down to $31.2 million, which indicates improving operational efficiency. And on top of that, the company reported $12 million in lease revenue, even though it only covered a partial portion of the quarter after the first Polaris Forge 1 building was energized. And according to CEO Wes Cummins, inbound demand has been meaningfully higher, which suggests that interest in the company's data center capacity is continuing to grow. But even with all of that momentum, there is still a major concern that cannot be ignored, and that is the company's financing situation. Because in March, Applied Digital issued $2.15 billion in senior secured notes at a 6.75% interest rate due in 2031 to fund the Polaris Forge 2 expansion. And this comes on top of an already existing $2.6 billion in debt, alongside $2.3 billion in cash and restricted cash as of late November. And what really stands out here is that interest expense in the previous quarter surged by 292% year over year, which clearly shows how quickly the cost of carrying that debt is increasing. And This is exactly why investors are becoming more focused on whether the company can scale its revenue fast enough to keep up with these obligations. Because if not, the balance sheet pressure could become a serious issue moving forward. And the company itself has already highlighted several risks in its filings that investors should be paying attention to, including potential delays in construction timelines, execution risks with major customers, and challenges in raising additional capital on favorable terms. And any of these factors could disrupt the current growth narrative and delay the path to profitability. However, there is also a potential positive development that could help ease some of these concerns, as CoreWeave recently secured $8.5 billion in new financing and received an A3 investment grade rating from Moody's, which could indirectly benefit Applied Digital by improving confidence in its key partner and potentially lowering its overall cost of capital, given how closely tied these contracts are. And it's also important to understand that Applied Digital is not alone in this environment, because the entire AI data center sector is experiencing a massive surge in demand for capital as companies race to build infrastructure to support the growing needs of artificial intelligence, with reports showing that projects like those tied to Oracle are attracting funding rounds as large as $16 billion, which highlights just how competitive and capital-intensive this space has become. And for Applied Digital specifically, this earnings report is absolutely critical because it needs to provide a clear and convincing narrative around cash flow generation, especially now that an additional $2.15 billion in debt has been added to the balance sheet, leaving very little room for uncertainty. So if management can demonstrate that lease revenue is ramping up in line with the scale of its contracts, then the bullish case becomes much stronger and we could see the stock react positively. But if there are still unanswered questions around timing, execution, or revenue growth, then pressure on the stock could increase significantly in the coming quarters, making this one of those key moments where the market is going to decide whether this is a long-term growth story that is just getting started or a high-risk setup that still needs more time to prove itself. So definitely keep a close eye on the numbers, the guidance, and especially the commentary from management, because that is where the real insights will come from. And if you found this breakdown helpful, make sure to like the video, subscribe to the channel, and stay tuned for more updates, because we cover all the latest moves in the market to help you stay ahead and make smarter decisions.